We will stay on the markets and reaction to the Fed decision and bring in our market guest, Jeff Schulze, investment strategist at ClearBridge Investments. Jeff, thank you so much for your time. I want to get your reaction to the moves that we're seeing in the equity market and frankly in the bond market as well, because on this decision yesterday, 24 hours ago, almost, equities were climbing. Even tech was up. And now we see some of those gains paired, and tech is deep in the red, which actually makes more sense to me because I was so confused why, when the Fed was so aggressive in their hawkish sort of turn, that tech was up as well. You know, these sort of stocks look for future cash flows, and an environment when rate hikes are prevalent, you know, those cash flows are discounted. So just want to get your take on what is going on in the markets right now.
Well, first off, thanks for having me on the program. And if you look at leadership, you've actually seen value leadership here for the last couple of weeks, even though you've had an overhang on the market because of the variant and the upcoming FOMC meeting, which we've just passed. So usually when you see leadership and rates have been down over this time frame, it usually signals what's likely to come as you move through the next couple of quarters. But I think obviously what's driving the market today is the US dollar. The US dollar is down fairly dramatically. It's been a nice tailwind to energy, materials, gold, for example. And it's not uncommon to see this. Usually the dollar will strengthen 6 months prior to a tightening cycle. If you go back to the last 8 cycles, and it'll actually weaken in the 6 months after that tightening cycle begins. So I do think that we're in the beginning of a weaker dollar period. But similar to the dollar, you actually usually see 10-year treasuries bottom right before the beginning of a tightening cycle and rise over the subsequent years. So I think markets recognize this dynamic that we're finally in this tightening environment, and they're starting to price in that new reality, even though the 10-year treasury hasn't followed through in the same sense shed as the dollar.
I just want to stick on the bond market right here. I'm looking at the 5-year T-note yield. That is down 8 basis points. 10 years down a little bit less, 4 basis points. 30 years up. So the conclusion here is we have a bull steepener in the yield curve, and I think that's kind of signaling risk on. And you noted the U.S. dollar index as well. That's down today. Had a big movement yesterday. So I'm just wondering. It seems as though we got a little bit of a surprise, a little bit of a hawkish surprise yesterday. But the markets, I'm not sure, really are discounted. Or excuse me, I think the markets have discounted that. I'm just wondering what your thoughts are on the yield curve right now.
Yeah, I think the markets were maybe expecting a more hawkish response by the Fed yesterday, so it was a little bit of a relief rally. But I think maybe what was driving the markets even further is the fact that the Fed is recognizing the inflation risks that are out there, and they're really chopping off the right tail of inflation, really getting out of control as we move later into the cycle. Now, the Fed may still be behind the curve, but they're rapidly closing that gap with having a taper that's twice as fast as what you saw back in 2013, and now their dot plot showing what the market has been pricing over the last couple of weeks, which is 3 rate hikes this year, 3 rate hikes next year, and then 2 rate hikes in 2024, which is actually a little bit more aggressive than the markets overall. So I think really what's driving the yield curve right now, especially on the nearer term with the 5-year treasury, for example, is the fact that inflation risks are being reduced.
Jeff, what was your most important takeaway from the Fed decision yesterday and comments from Fed Chair Powell? And then what does it mean? Put it into context for just the average person. How does their life change next year because of these rate hikes?
Well, you're likely going to see interest rates rise a little bit. So the cost of funding for car loans and obviously mortgages are likely going to rise marginally. But ultimately, I think the most important takeaway from yesterday is that the Fed is being pragmatic. They recognize that inflation is not transitory. It's been a little bit more persistent than what they had anticipated. And they recognize the risk to the upside, and they're starting to get in front of it. But Powell was non-committal, 2 rate hikes once the taper is complete. Again, they are data dependent. They're going to be looking to see whether or not they hit their maximum employment mandate. And I think once we get to March, depending on how this variant plays out and how the labor markets play out, they've given themselves a lot of options on what to ultimately do with Fed policy, and they haven't backed themselves into a corner quite yet. So obviously, I think this is a positive move for the markets and the economy. It takes away a lot of the fears and concerns that we were having with inflation. And I think the risks are more balanced as we look out across the horizon that the Fed is catching up to naturally where they should be at this point in the cycle.
And Jeff, just extending this discussion, just kind of looking ahead to 2022, how would you suggest people should be positioning themselves, given what we got from the Fed yesterday and given the trends that we've seen over the last few weeks, if not months?
Yeah, I think you really want to lean into the value cyclical trade. I know obviously growth has been the place to be over the last 6 months, but in this type of environment with a rising 10-year treasury, which is my expectation, which you've seen at the beginning of every tightening cycle, really since the last 8 tightening cycles that we've had, and the fact that I think we've seen the last disruptive wave of COVID in the US as we move past Omicron, we're going to have much more stability and higher growth next year. I think the cyclical areas of the economy and the market and value in particular are poised to outperform on a relative basis, especially now that valuations have come in so dramatically over the last couple of months.
And Jeff, I want to ask you, what are we seeing as far as, what's behind the inflation that we're seeing? Is it supply side issues and the pandemic, or is there also this huge demand that we're seeing coming out of nowhere?
It's a combination of both. If you look at activity and goods passing through the ports, for example, they're up close to 20% from where we were back in 2019. So you've had this surge of demand as people have substituted their spending for goods and at the expense of services. But as we go forward, I do think as we have a more normalized economy and these COVID disruptions become less disrupting, I do think that marginal dollar of spending is going to go from goods into services. And I think that's going to bring down a lot of the goods inflation that you've seen. And if you look since 2000, all of the inflation that you've seen in the US has been services inflation. Goods inflation has been literally zero before we've gotten to the COVID experience. So I do think things are going to normalize and goods inflation is going to come back down. And that's going to be a key driver of a inflation backdrop that's going to move closer to 2.5% on a core basis as we get to the back half of next year.
And thinking about the Fed's dual mandate, we're talking a lot about inflation, but also the labor market, the jobs front. We did get that NFP non-farm payrolls report that disappointed, at least on the headline number last week. But it looks like the unemployment rate continues to tick down. I'm just wondering, how close do you think we are to full employment, and what do you think the Fed is thinking about it?
Well, the Fed's going to look at a number of different metrics, but they've said that they see long-term unemployment being 4%. It went to 4.2% in the November payrolls report. So we're getting very close to that bogey. But I think they're also going to be watching the prime age labor force participation rate, those individuals in their 20s to their mid 50s, to see if this can move higher and closer to the levels that we saw pre-COVID. We've made a lot of progress. This has been the fastest recovery that we've seen in the prime age labor force participation rate over the last couple of cycles, but there still is a long way to go there. So if we can continue to make progress there and we get an unemployment rate below 4%, which I think is a very high likelihood by March, I think the Fed will feel comfortable that all of those people that have left the labor market have already come back in and that want to gainfully be employed. So I'm thinking we'll probably hit that mark maybe by March, but certainly by May for liftoff.
All right. And the Fed chair saying that there is a new measure for what full employment looks like. We'll have to leave it there. Jeff Schulze, investment strategist at ClearBridge Investments. Thank you so much for your time today.